In this video, we are going to talk about the terminal value as a closure in DCF valuation. Whether you do FCFE or FCFF, doesn't matter how you do it. Okay, this is very important part because most of us pay more attention to immediate couple of years cash flow, but when you think about the percentage of value, okay, terminal value is almost everything. Okay, so that's why it's very important, and your valuation number will be very sensitive to what you assume to calculate this terminal value. So a publicly traded firm potentially has an infinite life. The value is therefore the present value of cash flows forever. So whatever cash flow that you expect in the future, okay, and then discounted at the relevant cost of capital, then summation of that, those will be your value. And since we cannot estimate cash flows forever, we estimate cash flows for a growth period, certain fast growth period, and then in a stable growth period, we just lump it into terminal value, okay, for a growth period, and then the estimated terminal value to capture the value of the end of the period. So typically our valuation framework, okay, let me bring this Poseidon thing here back again. This, depending on your scenario of growth, right? Fast growth period, the cash flow fluctuates and it drastically changes, but after a certain point, you will assume some stable growth, and that will be lumped into something called the terminal value. Okay, and then as you see, importance of terminal value, this table, okay, all different companies, but the key idea is this: on average 90% of your valuation, okay, 90% of your value is coming from your terminal value. Why is this the case? Because think about this again, okay, the cash flow, if you think about dividend discount model, okay, the cash flow that you anticipate over the next 5 years, well, those dividend, okay, if you think about, Samsung Electronics dividend, they pay minimal amount of dividend, very small amount over the next 5 years, maybe next 10 years. I bet you their dividend payment will be very, very minimal because they have to reinvest so much to grow and compete in semiconductor industry. Most of the value that you estimate comes from your terminal value, which is your expected stock price at the end of your growth period 5 years down the road. Okay, if your scenario is like 5 years of fast growth and a 6th year, what would you do? The terminal value is nothing other than the anticipated price that you will get by selling the Samsung Electronics stock to somebody else, right? So that's the terminal value, okay? Majority of it, of your valuation number, will be your terminal value. So 90%, okay? Based on the statistics provided by the textbook author, Professor Damodaran. Okay, stable growth and terminal value. When a company's cash flows grow at a constant rate forever, the present value of those cash flows can be written as, expected cash flow divided by R minus G, the golden growth model, right? That's value. And then this constant growth rate is called a stable growth rate and cannot be higher than the growth rate of the economy of the country. One cap that you have is the GDP growth rate, okay? Even though if you build some rosy picture about your company, right? Well, your company cannot grow more than the world economy, okay? So if your company is more global company, well, the world's GDP growth rate, okay, should be your cap. That's the idea here. If your company is not a global company but a domestic company, your domestic GDP growth rate will be the cap of your future growth rate. That's the thing. While companies can maintain high growth rates for extended periods, they will all approach stable growth at some point in time. So otherwise, right over here, if you assume extremely high growth rate, faster than your world's GDP growth rate or your country's growth rate, what will happen in the infinite horizon? You can pretty much picture that your company will explode. Your company size will explode the GDP of the whole country or the whole world. You will be the ruler of the world, okay? You will be emperor, okay? Unimaginable thing will happen. So that's why cap has to be there. Anyway, when they do approach the growth, the stable growth, the valuation formula above can be used to estimate the terminal value of all cash flows beyond. The getting terminal value rate, okay, very important because it takes up 90% of your valuation number. The stable growth rate cannot exceed the growth rate of the economy, but it can be set lower if you assume that the economy is composed of high growth and stable growth firms. The growth rate of the latter will probably be lower than the growth rate of the economy. The stable growth rate can be negative. Your company, if it is in a declining industry, for example, internal combustion engine cars, right? Hyundai Motors, if they moved to electric car or hybrid cars, thankfully. But if your company stays in internal combustion engine industry, 내연기관차, that will be going down. The market size shrinks down, so the growth rate can be negative. Oh, is it okay mathematically? No problem, because your growth rate being negative means like R minus G. The G is negative, negative plus. Yeah? So your denominator will never be negative, okay? In that sense, no problem. Just your denominator will be bigger so that your valuation number will be smaller, right? So that's what's going to happen. If you use nominal cash flows and discount rates, the growth rate should be nominal in the currency in which the valuation is denominated. So consistency matters. Determinants of growth rate patterns, well, size of the firm matters. Typically, success usually makes a firm larger. As a firm becomes larger, it becomes much more difficult for them to maintain such high growth rate, in the long horizon. And then, however, when it comes to a young startup company, venture company, you need much more creativity and imagination to allow for various possibilities. And this is where the accountants or more conservative people have trouble, because venture company valuation, okay, you need to have a lot more degrees of freedom, and then you are allowed to do it. But for accountants, it's more like black and white, right or wrong, and right or wrong, and then you have to be more conservative, and then so they are not used to it, right? So this is something you need more flexibility. There in the venture valuation kind of things, what is the size of your dream, okay, will be an issue. Okay, now imagine you are valuing a certain company. I'm not going to disclose the name until the next couple of slides. A company in 1999, a dot-com bubble period. You were valuing this A something company, is very young and venture, and they were started to being traded in the Nasdaq market. Okay, so if you look at their ROE, terribly negative, minus 500, minus 800. Oh my God, is it imaginable, right? You were losing money, right? What company was it? I'm not gonna tell you, but it was a young venture company. It still got listed in the stock market and were traded, okay? And then the sales of the company, interestingly, it was exponentially growing fast, okay? And then, interestingly enough, if you look at their market value of equity, market cap, it was also exponentially growing. Yeah, terrible ROE, sales of only $1.8 billion. Still, the market cap was $25 billion. If you are an analyst for this company, would you say that the stock price is correctly reflecting the true value, or would you say it's a bubble and write a sell recommendation at this stage? Okay, would you do the DCF in a certain manner so that you can do some stock recommendation? Well, what company was it? Okay, that company was Amazon.com. Okay, you see Jeff Bezos over here. Nowadays, well established, and then is, after the fact, right? Didn't you know that this company will be so much successful? That's easier said than done, after the fact, right? But before the fact, young stage, right? Like this, right? Venture company stage, startup, terrible ROE, money losing situation. Could you have imagined, right? Would you have had imagined this, in 1999, okay? Market value of equity and sales and things like that, okay? When valuing startup companies and young companies, you need to be more imaginative and be able to build up your story, okay? I'm not telling you that you should tell a lie, okay? But you need much more degree of freedom, and then should be able to, okay, build up your story based on the vision the company the CEO has, and their, what the market is, innovation they bring, and how the market changes, and can AI really replace human imaginations in this sense is a real big challenge from now on, I guess. Now, sales, right, track record of the company was like this. And ROE, I told you, Amazon was experiencing very terrible ROE record. Will taper off in the future, but how soon? Well, the ROE projection, when you do DCF valuation for this kind of venture, right? You need some long horizon imagination so that the ROE will be converging to some kind of industry median, okay? Industry average, industry median, but how soon, okay? Half-life, 반감기, half-life kind of ideas. Well, would you be able to do this kind of things? Determinants of the growth patterns, you'll have to have some build-up stories, okay? This is where this typical Korean educated students will have a hard time, okay? Because we are not trained in our high school education to do that kind of imagination. Okay, forget about imagination. Okay, that was what we were brainwashed. Okay, but we have to overcome that limitation somehow. Size of the firm. Okay, successful usually makes a company larger, and then it makes more difficult to grow fast as before. Current growth rate. While past growth is not always a reliable indicator of future growth, there is a correlation between current growth and future growth. Thus, a company growing at 30% currently probably has higher growth and a longer expected growth period than the one growing 10% a year now. At the same time, people can get anchored on slow growth rate, like 8% or 10% growth rate, stable growth rate, even if your company is young. But the cash flow patterns, right? You have to be more imaginative. The pattern is typically more like drastic windfall of cash flow happens, and then unimaginable growth happens in the short run, and then all of a sudden that kind of cash flow stops. Okay, it can be more abrupt. Okay, so you have to be more flexible in that sense. And then barriers to entry and differential advantages. Well, here you look at the product market or service market that company is competing. This is where the Porter's 5 forces analysis matters, okay? And then ultimately high growth comes from high projected returns, which in turn comes from the barriers to entry and the differential advantages or competitive advantages. How sustainable is your competitive advantage, right? And then the question of how long growth will last and how high it will be can therefore be framed as a question about what the barriers to entry are, how long they will stay up, and how strong they will remain. Okay, and then getting terminal value right. Well, you have to be internally consistent in your scenario building. Risk and cost of equity and capital. Well, in the stable growth firm, stable growth, right? Well, stable growth firms tend to have betas close to 1 because they are, well established, and then the capital market cap will be large enough so that it would be, closer to market average. They tend to have debt ratios closer to industry averages or median, or mature companies' averages, right? That's what the stabilizing and the aging process is about. And then the excess returns at stable growth firms should approach to 0. That means your return on capital will converge to cost of capital, WACC. Your return on equity will converge to cost of equity. There is no free lunch in the market, so that is why. In the long run, right? ROC versus WACC and ROE versus cost of equity. Cost of equity? Well, after all, value adding means delivering better returns, either ROC or ROE, than what is required of the investors in the capital market, which is WACC or cost of equity, respectively. So while you have competitive advantage in your product market, you would have ROC being greater than WACC and ROE being greater than your cost of equity. As competition intensifies with more number of competitors into your market, your ROC and ROE would deteriorate, and eventually they would converge to WACC and RE respectively. This is what would happen in your stable stage life cycle. So competition intensifies, everybody jumps in so that your excess return will be lower. That's the story. Getting terminal value right. You have to be internally consistent. Risk and cost of equity and capital. Well, stable growth firms tend to, I told you about this before, and then the reinvestment needs and dividend payout ratios should reflect the lower growth and the excess returns. So stable period payout ratio will be 1 minus G over ROE because you have this relationship. G being equal to ROE times retention ratio, which is ROE times 1 minus payout ratio. And then stable period reinvestment rate should be equal to G over ROC because you have this G being equal to ROC times reinvestment rate. So you will have to incorporate this in your valuation exercises. And I provide some numerical examples of how I tried the valuation of Hyundai Motors as of 2011 and using FCFF method. So let's go one by one. I first looked at their historical track record to have some understanding about what's their life cycle stage, and then how is their ROC moving, and then how is their reinvestment rate, and then the reinvestment needs would be. Okay, reinvestment will be proportional to the revenues trajectory. And then if you look at the revenues, sales of the Hyundai Motors, well, they dipped temporarily in East Asian financial crisis, but they exponentially grew afterwards. And then their ROC and EBIT. ROC on the right hand side in dark blue lines were like this. They were rather stable and high at 25% ROC, and then EBIT margin was fluctuating at 8% level or lower. Why is it lower margin? Because cheaper car, and then they're not Porsche. Okay, they were not Porsche or Benz, so their margin was very low. But as you see over this period, it was kind of improving, kind of. And then EBIT and EBITDA of Hyundai Motor in monetary terms, right? They were exponentially growing in tandem with the sales growth. And then Hyundai Motors EBIT margin, I wanted to calculate EBIT margin average over their history and EBITDA margin as well over this long period. I may have been more conservative. But for just a example, numerical example, I was doing it, and then here I built up my assumptions to do the valuation. In 2011, Hyundai Motor was exceptionally well received in US and the EU. Why? Because it was right after global financial crisis. People felt very poor. They were buying cheaper cars than German Porsche, right? So the company, the Hyundai, has been aggressively investing in global production facilities such as an Alabama factory in the US. They were well positioned at that time. We believe that the historical average reinvestment rate was 191% of EBIT, after tax EBIT. Through the company, though the company cannot maintain such high level of reinvestment like 191%, we believe that we believe that the company will maintain above 80% reinvestment rate until year number 5. Also, the ROC of the company has been 25 to 30% range. To be more conservative, we assume that the company will maintain 27% ROE, which is just middle number roughly. In the future, after year 5, the company will have stable growth rate, terminal value 3%. Also, we assume that the ROC of the company will be 15%, which would give us the reinvestment rate of 20%. Okay, now normalizing earnings. Well, the car industry is a cyclical industry. Hyundai Motors EBIT margin has been volatile. You saw that volatility, okay? Data, go back as much as possible to understand the industry right away. And then since global economic outlook is still gloomy with the sovereign debt crisis in EU in 2011 and the US, we assume that the EBIT margin of HMC to be the same as historical average. Normalized operating income should be revenue in 2010 times average operating margin across this time period, 93 to 2010, which is 4.37%, and then multiplied it by the revenue in the previous year, and then the normalized operating income turned out to be 5.9 trillion Korean won. And then Korean marginal tax rate, well, let's assume it to be 25%. And then I did some spreadsheet work to project the cash flow over year number 1 through 5. And then year number 6, I had to go one more step. Why? To estimate the terminal value of free cash flow to firm. But from year number 1 through 5, let's go through free cash flow firm to firm first, year by year. So ROC was assumed to be 27% throughout, and then in the terminal 6 year and then going forever, assumed to be 15%. Reinvestment rate 80% in the fast growing stage, but 20% only in the terminal stage because stabilizing, right? And then the growth rate, fast growth of 22% every year until year number 5, and then 3% only in the terminal interval, right? Terminal period, year over year. And then EBIT, well, just grow it based on the previous year's EBIT, right? And then EBIT growth rate, 22% was applied every year, and then the 3% in this year stakes, and then apply the tax rate get to the after-tax operating income, and then from there I just reinvest 80% of after-tax operating income, and then I get the free cash flow to firm every year. Okay, and then year number 6, I just do it one more time based on this slow growth rate, and then estimate the terminal value using this one, and divide this 8 trillion Korean won by R minus G, the growth rate of 3%, and then R should come from our WACC, 9% assumed, and then the valuation of operating asset. Well, the present value of all these things, right? All these free cash flow to firm, and the terminal value at the year number 5. Add everything, okay, discount this guy. Terminal value has to be discounted over 5-year period. Don't forget that. People make tons of mistake at that time. And then this is the enterprise value, value of operating asset. This is enterprise value. And then 92.7 trillion Korean won. Don't stop there, because you have cash on your bank account. And then 18 trillion Korean won. Add those things too, and then you will get 110 trillion Korean won. That's going to be your market value of asset. And then what do? Subtract debt, because this is your funded debt from your debt holders, by the way. So to get to that, and then you get to closer to market value of equity. But before that, you have one more step. Because you have minority interest to subtract out of it. Well, in this semester, I'm afraid we will not have time to cover the minority interest. But the easy answer in this part is to subtract it, because it's not going to the common stockholders of Hyundai Motors, right? Minority interest has to do with your affiliated companies or your majority holding. Okay, that minority interest has to be subtracted, and then so eventually you will get to the market value of equity, 51.666 trillion Korean won. Then what do? You divide this by the number of shares outstanding, and then value per share will be obtained 234,000 Korean won. And to compare this with current price as of 2011, 212,000 Korean won. So my recommendation for this stock was buy, okay, weak buy, because it was not much different from the current value. So that was it. Well, that's it for the numerical exercise. And just to show you how the Hyundai Motor has been doing ever since, right? This is a time point I was doing this valuation. The current price was 212. My valuation was slightly higher than that over here. That's this period, okay? And then the price was hovering around, okay, for a long time. And then right now, it's skyrocketed to 710,000 Korean won. Did I purchase the stock and then kept on holding it until now? Hell no. I was impatient, honestly speaking. I just sold it over there somewhere. But in the meantime, right, they had a miserable time in 2015 with a bad mistake in management. And then eventually their price skyrocketed with this, more, technological innovation in AI, and then the automatic, driving vehicles, and then this, and new innovation going on. So new environment, new information got in. So that's why the stock price was fluctuating a lot more drastically. Okay. But anyway, so that's it for today. Thanks for watching, and then see you next class. Bye-bye.